Okay, good day to everyone. For this video, we are going to discuss current asset management. So when you talk about current asset management, basically this will focus on three items in your financial statement, which will be cash, accounts receivable, and your inventory. So let us proceed with the first part, which will be the chapter outline. So basically, this is going to be our topics. First, we are going to discuss the main concept of your current asset management. Next, we are going to discuss cash management. We are also going to discuss a bit of marketable securities because this is also part of our current assets. We will have receivable and inventory management, and also policy decisions required in your inventory management. And then finally, we're going to discuss liquidity in relation to returns. So let us first start with the concept of cash management. So as financial managers later on, you need to make sure that you are able to manage your cash flows properly. Okay? And you need to make sure that as much as possible you are maximizing the use of your cash. Okay? So it says here that financial managers actively attempt to keep cash or non-earning assets to a minimum. What does this mean? It means that as much as possible you need to make use, okay? You need to make sure that you are using the cash that you have. Because if your cash will be idle or your cash will not be used in the operations, then it is an asset that is not generating any income. Okay? So at most, if you have cash in the bank, okay, the least amount of earnings that you're going, or the highest amount of earnings that you can possibly earn in the bank is actually the interest, which is very minimal, particularly in our current case. Okay? So we need to make sure that we are utilizing our cash, and we keep it at a minimum, meaning we are only going to maintain enough cash that we will be needing for liquidity purposes. So it is critical to have sufficient cash, okay, to make sure that we are able to have enough resources or funds for emergencies. Okay? So meaning we are maintaining enough cash balances that are necessary for emergencies, necessary for expenses, and other expenditures or particular incurrence of certain costs. Okay, steps to improve overall profitability of a firm is number one, to minimize cash balances. We discussed this already, because if you have idle cash, then you are not maximizing its earning power or earnings capacity. And next, you need to have accurate knowledge of when cash moves in and out of the firm. Meaning, you need to make sure of, or you need to know the patterns of your inflows and your outflows. Okay? By doing so, you will know when you are supposed to have cash and when you are when you are going to receive cash. So with that, you can actually plan also your investments and plan where you are going to use your cash. Okay. So in relation to your cash balances, there are, just like what we said a while ago, there are certain reasons why we need to hold, or why we need to keep a certain amount of cash in our company or in our company's bank account. Okay? So first is for transactions. Okay? Meaning we are going to maintain enough cash balances in preparation for the payments of our planned expenses such as utilities, salaries, rent, and other operating expenses that we are anticipating for a particular period. Second, we need to maintain a cash balance for purposes of compensatory balances, okay, for bank loans or for certain loans that needs to be secured by what we call compensating balance. Okay, so this is basically in relation to whenever a company borrows money from a bank, what the bank will require from the borrower or from the company is for them to maintain a certain amount of cash, and this is what we call compensating balance or compensatory balance for that particular loan. And third is for precautionary needs, meaning we need to maintain a certain portion or a certain amount of cash that is going to be used in case there will be emergencies, okay, that will happen in the business. So in relation also to our cash management, we also need to understand the cash flow cycle. So when you talk about cash flow cycle, this is basically the movement of your cash going into cash going to inventory, and then going to receivables, and then going back to cash after there will be payments. Okay, so basically this is the cycle of your inflows and your outflows, or your cash receipts and your cash disbursement. So that's basically the concept of your cash flow cycle. So we need to ensure that cash inflows and outflows are synchronized for transaction purposes, meaning whenever we have cash and we invest that in inventory, or we place that to purchase inventory, we need to make sure that the succeeding processes, such as the sales process, the collection process, and the payments process, are in sync in order for our plans, or in order for our cash plans or cash budgets to be able to materialize. Okay, so cash budgets as a tool is used to track cash flows and ensuing balances. So we need to make sure also that, just like what we said, we need to make sure that the balances or the budgets that we created or we established are being followed, or at as much as possible there are no variances to this particular budgets. Okay, cash flow also relies on payment pattern of customers, speed at which suppliers and creditors process checks, and efficiency of the banking system. So what are we trying to do here, or what are we trying to say here? It means that our cash budgets should also consider the external factors, okay, or factors that are beyond the control of the business, such as first, payment patterns or our collections. Okay, payment patterns of customers or our collections, meaning if, let's say for example, the credit term for our customers is 30 days, meaning we need to collect the receivables within 30 days, there is still a possibility that some of our customers cannot pay or will not be able to pay within the 30-day period. So the question there is, what are you going to do? Okay, so meaning there will be changes or variances in our budgets, okay, as compared to the actual collections, depending on the payment practices or the payment patterns that we have with customers. Next is with regards to our payments to suppliers or our creditors, we also need to consider the credit terms that are allocated or that are extended to us. So similarly, okay, we need to consider what will be the maximum number of days that we need to that we have in order for us to pay our payables or pay our debts to our suppliers and creditors without paying any penalty. So that is one thing that we need to consider also. And of course, third will be the efficiency of the banking system, because generally if we are going to pay using checks, or we are going to pay using bank transfers and other methods, there will always be delays, okay, depending on the efficiency of the bank. Okay, like for example, there is a possibility that we already made payments, but because of the inefficiencies of the bank, there will be additional number of days of delay, okay, because of the processing that the banking or that the banks are doing. So that's basically one thing that we need to consider. So if you are the one paying and there is a delay in the bank, then it's actually a good thing for you, because there will be a delayed payment, okay, on your part. So meaning you still have cash, or the cash that you're supposed to use to pay up the liability, you can still use it for other purposes. But if you are the one who is receiving the payment, that is a bad thing for you, because instead of you receiving the payment now, you are going to wait for a number of days before you will receive the payment from the bank because of their inefficiency. Okay, so that's what we are trying to consider here. Okay, so to continue, we are also going to consider these particular factors. So for our cash inflows is of course driven by our sales. Okay, because the more you sell, the more you are going to have receivables. But then, if there are delays in the collection, then it will be influenced by other purposes or other items also. So basically, if you have cash, you're going to buy inventory and you're going to sell that inventory, then the sales that you are generating needs to be collected. But of course, you cannot immediately collect because of certain restrictions or certain external factors such as number one, the type of customers. So what does that mean? There are customers who pay promptly. There are customers who do not pay at all. And there are customers who pay after the due date. Okay, so basically, your collection patterns will be affected by these types of customers. Next is the geographical location of the customers. Why? Because the geographical location of your customer will affect the movement of cash or the movement of the payment. Okay? So if let's say for example, the customer is from another region or another country, okay? Then the payment or the wiring or the transfer of the payments can be delayed as influenced by the charges or by the delays caused by the bank transfer, delays by the the transportation or the freight relating to the checks that are being made, okay, or that are being used to pay up your or that are being paid by the customer, okay, and others. Okay, also your sales can be affected by your products, okay, that you are trying to sell. And of course, it is also going to be affected by the industry. So basically, what we are trying to say here is your sales and your collections later on will be affected by the various items that are stated here. So, of course, you cannot always assume that your budgets and what you are planning is going to materialize if there are external factors that we cannot control, such as items that are stated here. Okay? Next, when the cash balance increases, the extra cash can be used either for number one, for various payments to lenders, stockholders, government, and other stakeholders, or used to invest in marketable securities. So, basically, it's like this. If you have excess cash, you are not supposed to allow, or as a financial manager, you are not supposed to let that excess cash stay idle. You need to make use of that cash and make sure that you are maximizing its earnings capacity or maximizing the use of that particular cash. Okay? So, it's either you're going to use it for payments or you're going to use it for investments. Okay. Next, when there is a need for cash naman, okay, meaning there is a need for you to have more cash items, meaning you need to have additional cash for purposes of payments, okay, and other expenditures, then what you're going to do is to sell your marketable securities or borrow funds. So that's basically your options, okay? So that is a good thing if you have marketable securities because you can sell these marketable securities for emergency purposes, okay? But then if you do not have additional investments where you can get the money, okay, then your only option is to borrow, okay? And based on our discussion last time, it's either you're going to borrow funds on a short-term basis or on a long-term basis. But generally, if you're going to talk about loans that are for this particular purpose, meaning for the payment of your expenditures, most of your loans will be short-term. Okay? So this will illustrate the expanded cash flow cycle, and this will also give us an idea of how your cash flows will be affected. Okay? So basically, let's start with the item on the middle, which is going to be your cash. Okay? So your cash will increase with this particular items with the blue line. Okay, so your cash will increase whenever you have sales, whenever you collect receivables, whenever you sell your marketable securities, or whenever you borrow money from a particular lender. On the other hand, your cash will decrease if there is an outflow, and the outflow of your cash will usually be coming from inventories or the purchase of inventories, purchase of materials and other services, payments to the government, payments to your lenders, okay? Payments for interest and dividends and other non-operating expenses whenever you purchase marketable securities. So that's basically what's going to happen. If you're going to stay within the main concept of a business, then it's going to be like this. On the general operations, your cash will be used to purchase inventory. The inventories will be sold and it will be generated as sales. The sales could either be cash sales, which will automatically be reverted back to cash, or the sales could be credit sales, which would be turned into receivables. The receivables will then be used to or will then be collected, and this particular collections will go back to cash, and then upon collection, then that will be the time we are going to pay up our expenses and other liabilities. So it's up to you, but basically you need to plan your cash flow and you need to know the patterns and the timing of your inflows and your outflows. Okay, so with this, this is when we are going to introduce the basic elements of e-commerce, okay, that will help us be more efficient in our sales transaction. Okay, so that's the reason why we are introducing e-commerce. Actually, e-commerce is a concept and is a practice that is actually being widely used already right now, because it results to a more efficient and a faster processing of our transactions. Which means, by the way, when talk about e-commerce, basically we are simply trying to use technology. We are using the internet, we are using networks, and we are using connections and other hardwares and softwares in order for us to be able to make our operations faster. Okay? So the benefit of using e-commerce is basically there is going to be a faster cash flow when we are talking about collections or payments. Okay? So like an example there will be for credit card transactions, meaning if we are going to sell our goods, okay, and the payment that will be made is in the form of credit cards, okay, credit card companies will advance the cash to us as the retailer within 7 to 10 days. And if you're going to do that and compare it with the usual sales transaction wherein we are going to receive the payment from customers within 30 days, if that's the normal credit term, then there is actually a benefit of around 20 to 23 days. Okay, that is a benefit, because instead of waiting for 30 days before the payment term or before the credit term expires, you can actually receive the cash immediately from the credit card companies. Okay, and of course, these credit card companies are usually, if not all the time, backed up by another bank. Okay, so financial managers then should be able to pay close attention to the percentage of sales generated by cash, by credit cards, okay, which are outside credit cards and company-owned credit cards. Okay, so basically that is the concept there. So in order for us to be more efficient in our collections or in our sales using e-commerce, then we need also to make sure that we have enough monitoring and enough internal control to monitor these types of sales. Okay, so still we are in cash management. So for cash management, we are now going to go to the concept of float. Okay, so when you talk about float, basically this is the concept of having delays, okay, or the number of days that we are going to wait in order for us to receive our cash, or the number of days that we are going to wait before our payments will be cleared. Okay, so again, When you talk about float, this is simply the difference between the firm's recorded amount and the amount credited to the firm by the bank. Okay? So, it's like this. If I have a particular transaction today and I recorded it today as a receipt of cash, there is a possibility that the cash that I recorded in my books is not will not yet be credited by the bank because of the float or the delay. Okay? So basically there are two types of float that we need to understand. The first is the mail float, meaning the delay that is caused by the time that it takes from the time we sent the check or the time the check was sent to us and the time it is going to be delivered to us, or the time that the check that we issued will be delivered to the lender or the supplier. So basically that is the mail float. Okay? And the second is the clearing float, which is the amount of time that it takes to clear a check once the payment is made. So currently, there are the government has already established a particular policy, particularly relating to clearing float, that the clearing float should not exceed 2 days. I think the main practice right now is for a check to clear within 1 day. Okay, so meaning if or within the day if it is deposited within the clearing period. Okay, so this is basically how it works. If I have a check and I am going to have it deposited in my bank, okay, and if it is from another bank, what's going to happen is there is going to be a clearing period. Usually the bank will clear, or the checks that we deposit from 9 o'clock to I think 10:30 a.m., that's basically the rule, will be cleared within the day. But any cash or any check deposits that will be deposited after the clearing cutoff will be cleared the next day. Okay, so that's basically how it works. But it will be different from one bank to another depending on their policies. Okay, so this certain floats, the mail float and the clearing float, can be eliminated. Okay, can be eliminated if we are going to use electronic payments, or if we are going to have the new check clearing policy. This is actually in the US, but in the Philippines we have a different law. But it is going to be it has the same effect. Okay, so basically we are going to, banks are now required to electronically process a check in order for the clearing or the clearing float to be eliminated, if not for it to be reduced. Okay, so just like what I said, before if we are going to have checks from another bank that will be deposited to our bank, then it will take around 3 days before it clears. But now, because of the new electronic processing of checks, I think there will now be a 1 day float. Okay, if not, if you went to the bank earlier, then it is possible for your checks to clear within the day. Okay, but at most there will be a 1 day float or a 1 day delay to the crediting of your checks. Okay, so another way for you to improve your cash or your cash management is basically to do these two things. Number one is to improve your collections, and second is to extend your disbursement. So this is very basic. Okay, if you are able to improve your collections, meaning you are able to collect faster, then you will have more cash on hand. If you are going to extend your disbursements, then it means that before you pay up a particular amount or a particular expense, it will take a longer time. Then you will still have more cash that you can use for your operations. So in order for you to improve your collection, these are some of your options. Okay, first is to set up multiple collection centers at different locations. Okay, or second is adopt a lockback system, but this is not actually very oftenly used right now, because in the current setup, what we do is we do number one, which is setting up multiple collections, okay, or collection centers. And it is better if you are going to also enroll your companies to other online payments such as Paymaya, GCash, okay, and other electronic payments, okay, because that's going to make your collections faster. Okay, some of the companies also register their companies to 7-Eleven and other convenience store, okay, in order for them to have more payment channels or collection channels, okay. Now, how can we extend our disbursement? So basically, the general trend is we are going to, first of all, speed up the processing of incoming checks so that they can, or the company can have more cash, and they are going to slow down the payment procedure, okay, meaning they will, as much as possible, try to extend the disbursement float. So when you talk about disbursement float, this is going to be the delay from the issuance of check up to the time that it will clear the customer, or it will clear the receiver's bank, okay. So if we are the one who is paying, what we need to do is to extend the disbursement float, okay. So it allows companies to hold on to their cash balance for a longer time, okay. So let us now consider the cost benefit of doing this, okay. So the cost benefit analysis will now allow companies to determine whether the benefits arrived at doing a particular policy outweighs the cost in relation to using that particular program or a particular system. So it says here, it allows companies to analyze the benefits received by investing in an efficiently maintained cash management program. So just to give us an idea, basically it's like this. If our cash management program costs us around 5,000 pesos in order to maintain our cash collection system or our cash flow system, and the benefits arrived is around 3,000 only, then we are not supposed to continue the use of that particular program, because a 3,000 benefit compared to a 5,000 cost will only result to a negative effect or a negative return to our company. So as much as possible, we need to make sure that the benefits arrived will always outweigh the cost associated with establishing a particular program, okay. So with that, we go to cash management networks, okay, and this will basically give us an idea of how we can expand or how we can extend our cash flow, or how we can improve our cash management system. So again, there will basically be two steps there, or two policies. The first policy is for us to speed up our collection, and the second policy is to extend our payments, okay, in order for us to have more cash that we can use. It's going to be like this. We are going to establish collection centers, okay, and this will not be, or the best example will be banks, but it is not limited to banks. You can look for other online or other networks of collections wherein we can make our collections faster, okay. So from there will always be a transfer, okay, a transfer to our own bank. If we do this faster, if we do the collection faster, then we will have more cash, okay. Next, in order for us to have more cash, or have more cash on our hand, then what we also need to do, this is the second policy, we are going to extend our payment float, or we're going to make our payment or our disbursement slower. So what we can do is to we are going to extend our disbursement float, okay. So that's basically the concept there. So based on this example, if we reduce the remittance time by 1.5 days, it means that we are able to collect faster by 1.5 days. And if we are going to increase our disbursement time by 1 day, meaning instead of us paying, if let's say for example, instead of us paying within 20 days, we are able to do it, or we are able to extend it to 21 days. At least there is a 1 day float. If we are going to do that, then it will result to 2.5 days of freed up cash balance. Okay? 2.5 days of freed up cash balance multiplied by your average cash movement each day, it will result to 5 million available funds. So this is how it goes. If you are able to free up 5 million of funds, you can actually use this for other investment purposes, or for you to be able to earn from this particular freed up assets. Okay, so that's basically the concept there. So as much as possible, you need to, again, to reiterate, make your collections faster and extend your disbursement. Okay. So we go to electronic fund transfer. Basically, the concept here is for us to be able to transfer, or to, particularly if you are in an international operations wherein you have various operations in different areas in the world. Okay, the best thing that you do is to have electronic fund transfers. Okay, and in order for you to do so, if you are operating in various locations all over the world, then you could either make sure that you have an electronic fund transfer for the checks that you receive, okay, through an automated clearinghouse. Or you can also try to use international fund transfers through SWIFT accounts. Okay? So you can see this whenever you are going to receive or transfer money from one country to another. SWIFT talks about Society for Worldwide Interbank Financial Telecommunications, which is basically used by banks all over the world in order for one particular bank, one particular bank in the US to be able to transfer funds to the Philippines. Okay, so that's basically how it's done. So the benefit here is that it uses a proprietary secure messaging system, meaning it cannot be hacked, or there is an internal control. The message is encrypted. Every money transaction is authenticated by a code using smart card technology, and it assumes financial liability for the accuracy, completeness, and confidentiality of transaction. Meaning, your transaction through SWIFT accounts is actually going to be more secure, and you're actually going to have a better and faster bank transfer. Okay. We now go to international cash management. So under international cash management, these are the factors, or these are some considerations that we must have. Okay, so factors differentiating international cash management from domestic-based system. Okay, so again, most of our operations, or most of the businesses that we see, are local businesses, and they are simply using domestic-based systems. However, in the international setup, where again, reiterating that your operation is going to be in various locations around the world, then you need to establish international cash management, or cash management. And first thing that you need to consider is this one. Okay, so there will, under an international cash management, there will be differences in the payment methods, and there will be a higher popularity of electronic fund transfers. Okay, because of course we need to make sure that our collections will go to our central office or our central business. Okay, your cash management will be subjected now to international boundaries such as time zone differences, currency fluctuations, and interest rate changes, because generally you are going to consider that there will be boundaries from one country to another. There will be a different time zone between one country to another. There are different currencies used from one country to another, and interest rates are also going to be different depending on the central bank policies of one country as compared to another. Okay? There will also be a differing bank system and check clearing processes because this will be based on the um, legislations and based on the policies established in that country. There will also be changes or differences in account balance management and information reporting systems. And of course, there will be cultural, tax, and accounting differences again. So these are basically the considerations that you need to have whenever your operations is an international or multinational business. Okay. So to continue, we also need to consider this. Okay, financial managers should also try to keep as much cash as possible in a country with a strong currency and vice versa. So what are we trying to say here? Okay, if you're going to maintain your cash in a country with a strong currency, then it means that you have more, or your cash there has more value as compared to keeping it in a country with a weak currency. Okay, so if let's say for example currently basically you're going to play with the exchange rates here. So if let's say for example the United States right now this is just an example, if let's say for example the dollar is weakening and the peso is getting stronger, so what are you going to do? Get all your dollars and transfer it to the Philippines, convert it to peso because the peso is stronger. On the other hand, if let's say for example the US dollar becomes stronger and the peso becomes weaker, then what you're going to do is to transfer your money or keep more dollars and use more, or you lessen your peso denominations or your peso currencies, okay, as an international business. So that's basically what you're going to do there. Okay, next we also can use sweep accounts. Okay, sweep accounts allows companies to maintain zero balances, and whenever there is excess cash, it will be swept into an interest earning account. So when you talk about sweep accounts, this is basically talking about accounts that are only funded whenever needed. Okay, an example here will be the payroll account. So meaning your payroll account will usually have zero balance and it will only be funded whenever you need to pay salaries. So that's basically the concept there. So what you're going to do is you're only going to fund the payroll account whenever payment of salaries is already nearing, and then after all salaries are paid and there are still excess cash, then it will be transferred back to your normal bank balance. Okay. So that's basically for cash balance. Or cash management. We now go to our marketable securities. The question there is, why is it that a company should invest in marketable securities? Meaning, why is it important for us to invest in short-term investments? Usually, this will be stocks that are for trading, money markets, and other types of securities for short-term purposes. Okay? So basically, this is an example here. Okay? So this is a yield rate of short-term treasury bills. This is from the government. And this is the yield rate of long-term government securities. If we are simply going to look into the graph here, it is actually good for us to have marketable securities because this marketable securities has a high yield, meaning it is going to earn us interest, it's going to earn income if we're going to invest our money here. And again, investments are not limited to government securities. We can actually invest also in other private investments such as corporate bonds or the shares of stocks of other companies. Okay? In the Philippines, there is what we call the Philippine Stock Exchange, where we can invest our excess money to stocks of potential, or stocks that are listed in the Philippine Stock Exchange. Okay. So just like what I said, okay, whenever you have excess funds, you can use it to earn interest or to earn capital gains. Okay? And you can invest in various securities such as treasury bills, treasury notes, Federal agency securities are basically securities of the government. Okay? Certificate of deposit or time deposit for purposes of better understanding. So this is for time deposits with the bank. Commercial paper, this could be bonds or this could be other securities that are issued by private organizations. There can also be bank acceptances or bankers acceptances, or these are short-term securities that arise from foreign trade. So these are basically forex related investments. Okay? So that's basically where you can invest your marketable securities. The good thing about this is that it is highly liquid, meaning if in case you need cash, you can easily sell these items and you can get the money as faster. Okay, so I think the clearing for these types of securities is around, I think, 3 days also. Okay, so anyway, that is for marketable securities. That's just the concept there. So for marketable securities, the basic thing is for number one, for you to have excess cash, and number two, for you to choose a particular security where you are going to invest your excess cash. Okay, so that's basically how you can manage marketable securities. We now go to our receivables. Okay, so for the management of receivables, basically the first thing that you need to understand is that receivables are items that you need to value, because if you are not going to take care of your receivables, then you're going to lose all of the sales benefits that you initially had when you were able to sell the inventories. Okay, so accounts receivable should be treated as investments, and they should be based on a level of return earned equals or exceeds the potential gain from other investments. Okay, so generally what we're trying to say here is whenever you sell a particular item, it involves a gross profit that you are earning. So if you are not going to collect or if you are not able to collect your accounts receivable, then you are actually wasting the gross profit that you earned from the sale. Okay, so in order for you to manage your accounts receivable, you need to, number one, establish credit standards in order for you to extend credit only to customers that has a good credit standing or a good credit rating. Second, you need to have terms of trade, or what we call credit terms and payment terms, in order for us to establish a policy that is going to be followed by the customer for the payment of their liabilities to us, or for the collection of the receivables. And finally, we need to have a collection policy, meaning how are we able to, or how can we make sure that we will be able to collect all of the receivables. Okay, so this is just an example of yields, okay, or the returns that we can get from short-term investments, that is ranging from treasury bills to other money market items. Okay, and basically this is showing us that the yields or the returns that we can get is actually from 1980 to up to 2008. Actually, the yields are decreasing, and there is a rapid decrease actually on the returns. Okay, which means that if you're going to rely mainly on our short-term investments or our marketable securities, then it is not going to be enough. So we need to make sure that we are able to collect first our receivables, because this is the main source of our income, or the main source of the profits or the earnings of the company. Okay, so let us go first to the credit standard. So again, the first thing that you need to do is to establish a credit standard in order for you to be able to examine and to check the credit worthiness of your customers. Okay, and in order for you to extend credit only to customers that are, or that has a good credit rating. Okay, so the credit standards will determine the nature of credit risk based on the prior records of payment and the financial stability, the net worth, and other related factors associated with your customer. And in order for us to have a good credit standard, okay, we need to follow the basic 5 C's of credit, which will be character, capital, capacity, condition, and collateral. Okay? So, character basically talks about the what we call this. It's basically talking about the reputation of the customer, talking about the integrity, talking about how the company or how the customer represents itself in the industry or in the economy. Okay. Second is capital, to check whether the company or the customer has enough assets, enough net worth, okay, and enough cash, or talking about the capacity to pay. Okay. Conditions, meaning if the customer is able to meet the conditions established by your credit standard. And finally, collateral is whether the borrowings or the credit that we extend to a particular customers or to a particular customer is actually secured by a collateral. Okay. So this is not actually, I don't know if this is being used by the Philippines, but there is what we call Dun and Bradstreet Information Services, which is actually used to as a reference to the creditworthiness of a particular person. Okay. In the Philippines, I think we do not have this kind of credit check. Okay. Usually what we are trying to do here is to give a credit rating, okay, to a particular person or to a particular business to determine if this person should be extended with credit or not. Okay. So this is an example, okay, of a report, and this gives us an idea of what are the existing debts of a particular business, okay, are they overdue, and others. So with that, it will give you a credit score, okay, and the higher credit score means that you are more credit worthy. Okay, so this is a policy in the United States. In the Philippines, there is actually a different policy from one bank or from one company to another. So they do not use this particular system. But it would be good if the Philippines should also adopt a particular or this particular system wherein a person or a company will be given a specific credit score to determine whether debt or borrowing should be extended to a particular person or not. Okay, so that's basically how this works. Okay, so just for example, if in the Philippines, if this system will be adopted, I'm going to the bank and I'm going to borrow money. Before I can borrow money, they are going to check first my credit score. If I have a low credit score, then I cannot borrow the money. But if I have a high credit score, then most probably my loan will be approved. Okay? So that's also what's going to happen in the usual business setup if we are going to follow this particular system. Okay? And then, second is we're going to have the terms of the trade or credit terms, okay, which will give us a statement or an idea of how long the credit will be extended. Okay? So it has a strong impact on the eventual size of accounts receivable balance, and it creates a need for firms to consider the use of cash discounts. So basically, if let's say for example the credit term is 30 days, how can we encourage our customers to pay earlier than the 30 days? So what you can do is to extend a cash discount. Like example, the credit term is 30 days, but if you pay within 10 days, I'm going to give you 2% discount. So that's basically what you can do. And this cash discount is actually what you also learn in basic accounting. Okay, so that's basically how it works. And then finally, our collection policy, which is going to affect our days of collection or the average collection period. It will also involve the analysis of our bad debts and the aging of our receivables. Okay? So our credit policy will give us an idea of how efficiently or how effectively we are performing as to collecting our receivables. And this is actually one of the ratios that we need to understand or remember. Actually, you learned this already in the initial part of our discussion. Average collection period, which is going to be accounts receivable divided by the average daily credit sales. Okay? So basically, this will give us an idea of the average number of days before we can collect. And the goal here is to make the average collection period shorter. Okay? Also, we need to analyze the ratio of bad debts to credit sales because we do not want that our credit sales will be translated as bad debts. We want it to be translated as collections. And aging of accounts receivable to determine if there are past due or overdue accounts. Okay? So, which now brings us to an actual credit decision. So, let's have this example. So, assuming that we have this particular setup, okay, additional sales. So, let's say that we have additional sales of 10,000. You're going to generate additional sales of 10,000 if a policy is established, and it will result to 10% of uncollectible accounts, meaning our incremental revenue will be 9,000,000 9,000, but it will cost us 5% as a collection cost. So it's going to be 500,000. That's going to be 5% of the additional sales. So it will also result in the production and selling cost of 77%. So the annual income or annual incremental income will be 800. With tax rate of 40%, there is actually an annual incremental income of 480,000. So, or 480 peso, the dollars, okay? So with that, for as long as the end result is going to be positive, then we can push through with the credit decision or with that particular policy. Okay? Now the concept there is if there is an option that will result to a higher additional incremental income, then we go with that particular policy. Okay? So with this, if we try to compute for the accounts receivable turnover, that's going to be sales divided by the turnover. For us to get the accounts receivable, this will result to additional accounts receivable of 1,667. Okay? So the concept there is, if we follow this will be the additional receivable, but at the end of the day, we need to make sure that we will be able to collect this. Okay? This additional receivable. Okay. So that is the concept there. We now go to inventory management. So with inventory management, basically, first thing that we need to understand is there are different kinds of inventory items. The first inventory item is what we call raw materials, or these are the goods or the materials that we use in the production process. We have work in process or work in progress inventory, which are items that are not yet fully finished. And we have the finished goods, which are already ready for sale. Okay? So, as part of our inventory management, we must first understand that the amount of inventory that we have is affected by the sales, the production, and the economic condition. So, meaning, if let's say, for example, we have 100 units of inventory, if it is on demand or it is highly in demand, then you can actually sell all of your goods within one day. Okay? But the question is, what if the demand is 100,000? Let's say, for example, the demand is 100 units and you only have 30 units, then you need to produce an additional 70 units to meet all of the demand. Okay? And then finally, economic conditions. What if the economy started to be in recession? So your product becomes unsaleable. Okay, then you're going to have more inventory in stock because you cannot sell the inventory anymore. So you need to consider these three items: the sales, the production, and the economic condition in determining your inventory management policy. Okay? And we also need to understand that inventory is the least liquid asset. Okay? The least liquid of all the assets, and however, it should provide the highest yield. Okay? Meaning, since it is least liquid, the thing that you need to do here is to sell it as fast as possible, okay, in order for you to collect also the cash related to the inventories being sold. And why is it that it has the highest yield? Just like what we said, because when you sell a particular inventory item, there is a gross profit associated with that, and that gross profit is actually the yield that we are earning from this sale. Okay, so we are now going to discuss the concept of how we are going to determine our production level based on the seasonality or based on the kind of operations that we have. So, under level production, just like what we discussed in the previous chapter, we are going to produce the same amount of goods, okay, from one period to another, okay, wherein we are maximizing the capacity of our manpower and our machinery. Okay? The downside there is you're going to have higher inventory during the lean seasons, but then it will be consumed later on during the peak season. Okay? So, this is the level production. Okay? The second thing that you can do is the seasonal production, meaning you are only going to produce whenever the peak season is nearing. Okay? So, the good thing here is it eliminates inventory build-up because you're only going to produce as you need them. Okay? However, it will result to unused capacity during the slack periods, meaning you are still going to pay up your manpower or your labor even though they are not producing. Okay? And you're also going to have idle capacity in your machinery. Okay? And third, it may result in overtime labor charges and other equipment repair because of the overproduction during the peak season. So, it's up to you later on if you're going to use level production or seasonal production. Okay? So, that's basically your choice. But then there are pros and cons. Okay? So, it depends upon you as the financial manager and upon the company if they are going to follow level production or seasonal production. So again, to reiterate, level production will simply apply the concept of producing the same amount of inventory regardless of the seasonality of the product. So this will result to a more uniform production. Under seasonal production, you're only going to produce during the seasonal or during the peak season, but then it will result to more labor and more equipment usage, which will result maybe to more expenditures. Okay, so it's up to you. Okay? So also, in inventory policy, we also need to consider inflation and deflation. So inventory position can be protected in an environment of price instability by number one, taking moderate inventory positions. In other words, you only maintain a minimal amount of inventory. And second, hedging with a futures contract to sell at a stipulated price some months from now. This is an advanced topic, but basically the concept here is you're going to look for advanced buyers and you're going to sell it at a fixed price. Okay, so that's the concept of hedging. Okay. Rapid price movements in inventory may also have a major impact on the reported income of the firm. So, which means that if, just like what we said, if the product is highly on demand, then you can actually increase the prices, okay, in order for you to benefit more from the sale. But then if your product becomes less in demand, then what you do is to reduce the selling price so that you can sell and you can dispose of your inventory items. Okay, so this is our inventory decision model. So this is actually what we call the EOQ. Okay, the EOQ model. Okay, so under the EOQ model, there are basically two things that you need to consider: the carrying cost and the ordering cost. So meaning, in purchasing or in considering how many units of inventories you're supposed to order or you're supposed to buy, you need to consider the carrying cost and the ordering cost. So carrying cost contains interest on the funds tied up in inventory, meaning the cost of the cash or the cost of the money that you're going to invest in inventory. Second is the cost of warehouse space, insurance premiums, and materials handling, because the inventory will be kept in a warehouse, and other implicit costs associated with the risk of obsolescence and perishability. So that's carrying cost. On the other hand, ordering cost is going to be from the cost of ordering itself and the cost of processing inventory into stock. Okay, so that's the ordering cost there. So we now go to the optimum inventory level. Okay, so it's going to be like this. The black line is going to be the total cost, the red line is the ordering cost, and the blue line is the carrying cost. So basically, if you try to look at this, the more units you order, okay, or the more units you're going to purchase, the higher carrying cost you're going to incur. Why? Because carrying cost is a factor of quantity. Okay, meaning if you order less, there will be less carrying cost. If you order more, or if you purchase more, you are going to have a higher carrying cost. Okay? However, ordering cost will be reduced, okay, or will be declining or decreasing if you're going to order more. Basically, it's like this. If you order one time only, then you're going to incur ordering cost once only. Okay? If you're going to order more multiple times during a period, then you're going to incur higher ordering cost. Okay, so that's basically the concept there. And the optimum inventory level is actually the place where there is going to be the lowest total cost associated with the carrying cost and ordering cost. So if this is the plot of your total cost, then this is going to be your optimum order level. Okay, so or the EOQ. Okay, so with this we can actually use the graph to determine what is the optimum level, and based on the graph, the optimum level is actually 400 units. So if you order 400 units, okay, at a certain order period, then you're going to have the least number of, or the least amount of cost associated with the inventory. Okay, so this is where the EOQ, or the economic order quantity, comes in. So basically, we are going to use a formula that will give us an idea of the optimum level of our orders, or the optimum quantity that we are supposed to order whenever we are going to purchase a particular inventory. So the EOQ model is computed by getting the square root of 2 multiplied by S and O divided by C. So S is represented by total sales in unit, O is the ordering cost, and C is the carrying cost. So assuming that the sales level is 2,000 and the ordering cost is 8, okay, for each unit or for each order, and the carrying cost is 20 centavos, then using the formula, the EOQ is 160,000, which means that we are supposed to order 160,000 at a given order time, or at a given period of time. So meaning every time we are going to purchase inventory, the quantity should be 160,000, because it will result to the lowest inventory cost. Okay? With regards to the ordering cost and the carrying cost. Okay? So there. So so this is actually 160,000 without, what's this? Let's try to check the formula. I think this is wrong, but the correct answer is 400, because if we go to the previous slide, if we go to the graph, the order size is actually 400, so that's the optimum level, or the EOQ. So using the formula, we're supposed to get 400 also. So let's try to get this I think there is an error on the amount. So if we're going to get, let's have the calculator first. So if we have 32,000, that's 32,000 divided by 20 centavos. Okay, so the 160,000 is actually the item here. If we're going to get the square root, okay, if we're going to get the square root of, how can I get the square root? Let's just get the scientific. Okay, so if we're going to get the square root of, where is that function? Oh. Okay, so if we're going to get the square root of 160,000, you will actually get, square root. Sorry, that's wrong. Okay, so the square root of 160,000 is actually 400. So basically, it means that this solution is correct. The economic order quantity, or the most efficient number of units for every order, should be 400 units. So you're going to simply follow this formula for you to determine the number of units that you're supposed to order. Okay? Next, we also need to consider safety stock and stock outs. Okay, so this is in relation to your inventory or your sales, okay, and your production, or your sales and your stock, okay, or the number of inventories that you have. Okay, so there is what we call stock out, okay, wherein this happens whenever an item is out of stock. Okay, so meaning the people wants to buy this particular product from your business, but it is out of stock. And second, this also happens when you are unable to sell or deliver the product. Okay, so this is what you call stock outs. This is something that we must avoid in the business as much as possible. So in order for us to avoid this, we are supposed to apply a safety stock. Okay, safety stock reduces the risk of having stock outs, and as a result, okay, this will result in an increase of inventory due to the rise in carrying cost. Okay, so it will really increase your inventory cost, but then this is basically an offshoot of having a safety stock. For as long as we are able to maximize, okay, the safety stock, then it's okay. Okay, this cost should be offset by, number one, eliminating lost profits due to the stock out, and increased profits from unexpected orders. So just like what I said, yes, it is true, we are going to incur additional cost because we are going to have a safety stock, but it will eventually be offset later on by the additional profits that we're going to generate from the sale, or from the additional sale. Okay, so basically it's like this. If we are estimating that every day we are going to sell 400 units, and we are going to have a 20% safety stock, or let's say just 10% safety stock, so we need to maintain 400 plus 10%, which is 40. So we need to have 440 units in our inventory, just in case there is going to be unexpected orders or unexpected sales. Okay, so just to make sure that we do not have stock outs. Okay, so that's the concept there. Okay, so it's like this. So to have a computation, let us assume that we are going to compute for the safety stock. Okay, so if we have the EOQ is 400 and the safety stock is 50, okay, so what we are going to do here is, for every additional, okay, for the additional stock that we have, we are going to incur $50. Okay, so with this, okay, if it's going to increase by $50, what we need to do is to make sure that we are going to recuperate, or we are going to offset this particular cost with the additional sales that we are going to generate later on. Okay, so how are we able to compute the carrying cost? basically you are going to get the average inventory in units multiplied by the carrying cost per unit. Okay? So that's why EOQ divided by 2, okay, plus 50. Okay? That's why we get $50 here. Okay? So that's basically how it was computed there. Okay. So there. So if we have, basically this is this is going to be 400 divided by 2, so that's going to be 200 plus 50, that's going to be 250 multiplied by 20 centavos. Where did we get 20 centavos? That was from the original computation that we had a while ago, which is this one. So it states there that 20 centavos is the carrying cost. Okay, so that will result to an additional $50 in our carrying cost. But again, we can recuperate this by or through our additional sales. Okay? Another way by which we can manage our inventory is by using just-in-time inventory management. So just-in-time, from the term itself, just-in-time, meaning we are only going to produce inventory just in time for its sales. Meaning this is going to result in a zero inventory level, okay, which will basically mean that we are going to have zero carrying cost. Okay, so the basic requirements for just-in-time inventory is, number one, there should be quality production that continually satisfies customer requirements. Meaning even if we are following this system, we are still able to produce at the same quality or if not higher quality. Next, we should have close ties with suppliers, manufacturers, and customers. Okay, basically, this simply means that because we are following just in time, we need to make sure that we have, as the producer, we need to have a close tie with the supplier so that the suppliers can provide us with the raw materials as early as possible, just in time for production, and we are able to deliver to the customers the goods that we promise them. Okay? And finally, requirement number 3 is it minimizes the level of inventory, and as much as possible, there should be zero inventory if the company can. Okay? Cost savings from lower inventory. On average, just-in-time has reduced inventory on sales ratio by 10% over the last decade. So basically, it means that there will be lower inventory costs, so there will be additional funds or additional cash available for the business, and there is a lesser risk for obsolescence and unsold inventory. So in theory, just-in-time is actually a good practice because you are not, or you are only producing goods that are going to be sold. So these are the advantages. So advantage number 1 is it there is a reduction in the space that is needed in the warehouse because basically you don't need the warehouse anymore. Second, reduce construction and overhead expenses for utilities and manpower. Okay? Because basically, since there are no overproduction, then you are only going to pay your manpower and you're only going to use utilities and equipment when you need them. Okay? Better technology with the development of electronic data interchange system. Okay? Basically because you're going to rely on the system that will feed your operations with the necessary information regarding your production, okay, based on the sales needs of the or the sales needs that are demanded by the customer. And there is a reduction in cost from quality control. In theory, again, because basically it simply means that under a JIT system there is a higher quality control. Okay. And of course, there will be elimination of waste because we are only producing what we need to sell. So what are the areas of concern, however, under just-in-time? First is integration cost because there will be a cost related to integrating your your suppliers with your operations and your operations with the customer. Second is parts shortages could lead to lost sales and slow growth. Because basically, if a supplier or if the supplier cannot provide you with the materials that you need, you cannot produce the goods. If you cannot produce, then you cannot sell the goods. Okay, so that's going to be a problem. So the reason for this is because there are unforecasted increases in sales. So meaning the company is not able to keep up with the demand. And second is there is an unforecasted decrease in sales, so there is still a pile up of inventory. So in other words, you cannot efficiently use just in time if this particular two factors appear. Okay, and next, a revaluation may be needed in high growth industries, fostering dynamic technologies, meaning you are going to invest more in equipment and other technologies because you want to keep up with your just-in-time system. So that's another disadvantage. So that's basically the end of our discussion for our current asset management. So you can go through with the handouts and with the PowerPoint presentation. Okay, and that's basically the topic for this particular chapter. Thank you.